All right, in this chapter, we're going to talk about reporting and analyzing receivables. You guys are more than halfway through the semester at this point, so hang in there. We're in the home stretch. All right, learning objectives for chapter 7. Describe an accounts receivable and how they occur and are recorded. We've already kind of learned that in the earlier part of the book, but we'll get in a little bit more detail here. We'll talk about some notes receivable, how we compute maturity dates and record interest and that sort of thing. From an analytical perspective, we'll look at accounts receivable turnover, and then from a procedural perspective, we'll look at the different methods for valuing accounts receivable and writing off bad debt and estimating bad debt. Okay. All right, first let's talk about a receivable. What is it and how are they recorded? All right, valuing accounts receivable. So a receivable is an amount that is due from another party, right? Anything that has receivable in the name, we know are asset accounts, right? So what they're showing you here is a graph of the receivables that are due from various customers, and the analytical presentation of it shows the percent of each customer's balance to the total percent of assets. Okay. So a company must maintain a separate account for each customer that tracks how much each customer owes. So that's what we call typically like an account receivable subsidiary ledger. It will list each customer and the total amounts that are owed by that customer as of whatever date you run it. Okay? All right, sales on credit. So let's assume that on July 1st, TechCom had a credit sale of $950 to CompStore and a collection of $720 from RDA Electronics from prior credit sale. Credit sale, same thing as an account receivable. Okay. So the July 1st sale to CompStore, we're going to debit accounts receivable and credit sales. And then the cash that we collect from RDA on July 1st, we're going to increase cash with a debit of $720, and we're going to reduce RDA Electronics accounts receivable with a credit of $720. Okay. Now, typically if you're making credit sales and you're selling merchandise, right, there's two entries that have to be made. You have to record your revenue and you have to record your cost. We're just forgetting about the cost part for purposes of this illustration. Okay. All right, sales on credit, accounts receivable ledger. So what they are trying to show you here, I believe, is just, let me find my pointer. Oh, good grief. Please hold. My pointer's not working. Okay, so what they're trying to show you is that these journal entries up top in the blue get posted to the general ledger accounts receivable, but there's subsidiary ledgers. So the general ledger accounts receivable is that greenish, bluish box on the bottom left, and then your two pink boxes on the bottom right show the individual ledgers for the customers, RDA Electronics and CompStore, right? So your accounts receivable subledger supports your accounts receivable ledger, and there's usually a schedule of accounts receivable that'll just list the customer name and the balance owed, and the total should agree to your accounts receivable general ledger. Okay. All right, sales on store credit card, right? So on November 1st, TechCom recorded sales on their own credit card in the amount of $1,000. And then on the 31st, we recorded an adjusting entry for the interest earned at a rate of 1.5 per month on the seller card. So they made a sale on their own store credit card, right? So we record accounts receivable for $1,000 in sales for $1,000. And then on the 31st, we have to make an adjusting entry to recognize the interest earned on our store card. We're the issuing party of that credit card. And so we're going to record an account receivable of $15 and interest revenue for $15. Okay. All right, sales on bank credit card. So TechCom has $100 credit card sales with a 4% fee, and it's $96 cash is received immediately. So if you're a business and you accept like your standard Visa, MasterCard kind of payments, you're not going to collect the full amount of your sales, right? The credit card company has to make some money. So that's what they're illustrating here. So when you make a sale on just a normal bank credit card, you're going to record cash equal to whatever the net of 100% of your sale price less whatever the fee is on your card. So in this case, the fee is 4%. So your cash is going to be 96% of that $100 sale, or $96. You're going to record credit card expense of 4 and sales of $100. Okay. Again, omitting the inventory entry for purposes of this illustration. All right, so you can also make sales on installment. So installment sales, basically they're amounts that are owed by customers from credit sales for which payments required in some kind of a periodic amount over an extended period of time, and their customers are usually charged interest. All right, so small retailer allows customers to use 2 different credit cards in charging purchases. The AA Bank card assesses a 5% fee for credit sales. Visa card assesses a 3% charge on sales for using its card. So the retailer also has its own store credit card. As of January 31st month end, the retailer earns $75 in net interest revenue on its own card. Prepare the journal entries for the following transactions. The retailer uses a perpetual inventory system for recording sales, which I'm not really exactly sure why that's relevant, but I'm sure we'll find out. So let's go. January 2nd. So on January 2nd, we sold merchandise for $1,000 that had a cost of $600, and the customer accepted, or the seller accepted the customer's bank card. So in this case, we're going to sell merchandise for $1,000. So we're going to have, all right, let's start with the sale. So we're going to have $1,000 credit to sales. We know that the AA Bank card charges a 5% fee. So our credit card expense is going to be $50. $1,000 times 5%. And we're only going to collect cash equal to 95%, right? Then I think we have to record our cost of goods sold in our inventory. So they told us that the cost of the goods that they sold was $600. So we debit cost of goods sold and we credit inventory. Okay. On January 6th, we sold merchandise for $400 that had a cost of $300, and we used the Visa card, which has a 3% sale or charge on sale. So we're going to record our $400 sale. So we're going to credit sales. Then we got to record our credit card expense, which is just an expense account like any other. So you debit that, right? 400 times the 3% fee. And then our cash is going to be the net, $388. Then we need to record our cost of goods sold for that January 6th sale. So we will debit cost of goods sold for $300. They tell us that amount, right? Right here's our $300. And we're going to debit inventory. Then on January 31st, we have to recognize the interest revenue on our own store card for January, and they tell us what that is. So we just record an account receivable credit or debit of 75 and interest revenue credit of 75. Okay, so hopefully that made sense to you. Let's move on to the next. All right, so applying the direct write-off method of accounts receivable. So we talked about the different write-off methods and estimation methods for allowance for doubtful accounts briefly in class in the meet session this week. But we're going to get into some more detail here in this PowerPoint presentation. So first up, direct write-off method. So some customers may not pay their accounts, right? Not everybody is a faithful purchaser and pays their debts in full. So there are 2 methods of accounting for bad debts. There's this direct write-off method and then the allowance method. So under the direct write-off method, when Telcom determines that they're not going to collect this $520 from customer J. Kent, they're just going to reduce their receivables with a credit and they're going to debit bad debt expense. So the specific customer is noted in the transaction so we can make the proper entry in the accounts receivable subsidiary ledger. So just like those first examples when we were making the sales to those particular customers, that's why that's done that way. Okay. So under the direct write-off method, when we recover a bad debt, on March 11th, J. Kent was able to make full payment to Teccom for the amount previously written off. Well, if you get a payment for a balance that you've already written off, you have to put the balance back on your books before you can record the payment. So that first journal entry there is just reversing what we had just done in the previous slide. So we have to put the balance back on our books. So we're going to debit our account receivable, and we're going to credit our bad debt expense. And then you can record the cash. So you would debit cash and you credit your accounts receivable because they've now paid it. Okay? Okay, so assessing the direct write-off method. So way back to chapter 1, we talked about the expense recognition principle requiring that expenses be reported in the same accounting period as the sales they help produce. The materiality constraint permits the direct write-off method if results are similar to the allowance method, but generally the direct write-off method doesn't usually best match sales and expenses because you're not finding out that those accounts aren't going to be paid until well after you made the sale. So that's why typically the allowance method is used instead. So before we move to the allowance method, let's look at two examples here. So the retailer applies the direct write-off method in accounting for uncollectible accounts, and they want us to prepare the journal entries for the following selected transactions. So on February 14th, they determined they can't collect $400 from ZZZ Company. So our journal entry on February 14th is going to be a debit to bad debt expense and a credit to accounts receivable dash ZZZ Co. Then on April 1st, ZZZ Company unexpectedly pays its account in full to the retailer, which then records its recovery of this bad debt. Ironic that it's on April Fool's, right? Isn't that April 1st? Like, just kidding. I'm going to pay you. Anyway, so we have to put our receivable back on the books, right? So we're just going to reverse what we did on February 14th, and then we're going to collect our cash, debit cash, credit accounts receivable. Okay? All right, applying the allowance method to accounts receivable. All right, so the allowance method, at the end of each period, we just estimate what we think bad debt expense is going to be. Or otherwise said, we estimate what we think we're going to realize from that period's sales. So there's two advantages to the allowance method. It records estimated bad debt expense in the period when the related sales are recorded. And it reports your account receivable on the balance sheet at the estimated amount of the cash to be collected, otherwise known as net realizable value. So, allowance method, recording bad debt expense. So TechCom has credit sales of $300,000 during their first year of operations. At the end of the first year, $20,000 of credit sales remained uncollected. And then based on the experience of the business, they estimate that $1,500 of that accounts receivable balance will not be collectible. So we're going to record an allowance for doubtful accounts for that estimated $1,500. So we're still going to debit bad debt expense, no different than the write-off method, direct write-off method. The difference is that we're going to record a allowance for doubtful accounts, which is a contra revenue account. So it works the opposite direction, or a contra asset account. Geez, oh Pete, excuse me. Allowance for doubtful accounts is a contra asset account. And so it works the opposite of asset accounts, in meaning that the balance is increased with credits, not debits. Okay? So debit bad debt expense, credit allowance for doubtful accounts. Post them to your T accounts. Then we're done. So what that looks like then on the balance sheet is that you've got your accounts receivable less your allowance for doubtful accounts, right in the left column, and then your subtotal or your net in the far rightmost column. Okay, that's one way to present it. The other way is that second box. You just report it in one line, allowance or accounts receivable, and then you put in parens net of a $1,500 doubtful account, or net of $1,500 allowance for doubtful accounts, or allowance for bad debts. They can be any of those phrases, really. Okay. All right, so the allowance method, writing off a bad debt. So TechCom has determined that Jay Kent's $520 account is uncollectible. Well, we already allowed for it, so we've already blown it through our income statement in that last entry because we debited bad debt expense and we credited our allowance. So then from there, when you figure out something's for sure uncollectible or you decide to write it off, instead of hitting your income statement at that point, you're just adjusting the balances on your balance sheet. So we're going to write off the $520, which means we reduce our allowance account, and we do that with a debit, and then we reduce our accounts receivable with credit. So when you write off bad debt and you're using the allowance method, it doesn't affect the net realizable value of your accounts receivable. Because before our write-off, we had $20,000 in accounts receivable, less our allowance of $1,500. When we decide to write it off, all that's changing are our individual balances, but our net realizable value of accounts receivable doesn't change. Okay? All right, so if you're using the allowance method and you recover a bad debt, so let's say Jay Kent says, oops, just kidding, I'm going to pay you. So he sends us some money. So all we do is we reinstate the account we previously written off, just like we would under the direct method. It's just you're using different accounts. You're reinstating your accounts receivable, which is the same as the direct write-off method. The difference is that your credit goes to your allowance for doubtful accounts, not your bad debt expense. Okay, that's the only difference. And then when you receive your cash, same thing. You debit cash and credit your accounts receivable. Okay? All right, so retailer applies the allowance method in accounting for uncollectible accounts. Prepare the journal entries to record the following selected transactions. So on 12/31/2000 X1, the retailer assumes $3,000 of its accounts receivable are uncollectible. So we're going to record bad debt expense for $3,000, debit, and credit allowance for doubtful accounts for $3,000. Then the retailer determines it can't collect $400 of its account receivable from customer name ZZZ Company. Well, since we're using the allowance method, we're going to reduce our allowance for doubtful accounts by $400 right here, and we're going to reduce our accounts receivable. Nothing hits the balance sheet here, right? Because you already recorded that here. Then on 4/1 of 2000 X2, the company unexpectedly pays ZZZ Company unexpectedly pays its account in full to the retailer, which then records its recovery of bad debt. So before you can record the cash that you receive from your delinquent customer, you have to put the balance back because you've written it off. So you just do the opposite. This is just the exact opposite of what we did here. Then you record your cash. Debit cash, credit accounts receivable. Okay? All right, estimated uncollectibles based on sales and accounts receivable. So there's two methods to estimate bad debt expense: percent of sales and percent of accounts receivable, or aging of accounts receivable. So if we're using the percent of sales method, we compute our bad debt expense estimate by taking current period sales times some bad debt percentage to estimate your bad debt expense. So if Musicland has credit sales of $400,017, and it's estimated that 0.6% of credit sales will eventually prove uncollectible, we're going to take the 400,000 times 0.6%. They're going to estimate their bad debt expense should be $2,400. So we debit bad debt expense and we credit allowance for doubtful accounts. Under the percent of receivables method, they're going to take the year-end account receivable balance times bad debt percentage rather than sales times bad debt percentage. So the way that's computed is total estimated bad debt expense minus previous balance and allowance account equals current bad debt expense, right? So let's look at an example. Musicland has $50,000 of accounts receivable, $200 balance in its allowance for doubtful accounts. 5% of receivables are uncollectible. So if we take the $50,000 account receivable balance times 5%, they're saying that our allowance for doubtful accounts should have $2,500 in it. Well, we got to go back to our methodology from earlier in the semester where we said, what does the account equal? What should it equal? And what do I need to book for the difference? So it currently has a $200 credit balance, and it needs to have a $2,500 credit balance. So in order to bring our allowance for doubtful accounts from $200 to $2,500, what do we do? we credit $2,300, right? And then your debit is $2,300 to bad debt expense. All right, so the other method is aging of receivables method. So each receivable is classified by how long it's past due. It's what we call aging. And each age group is multiplied by its estimated bad debt percentage, and then they're summed up to get the total for the group. So typically, an account receivable aging looks something like this. You have all your customer names, you have the total amount due, you have the balance in the current bucket or the not due yet bucket, then you have the amount that's still outstanding that's 1 to 30 days past due, then you have a 31 to 60 day past due bucket, a 61 to 90 past due bucket, and then over 90 days. Some agings will have 30, 60, 90 over 120. That's what we use. Really, I think they're generic to whatever software programs are being used. I presume they can be customized, but nevertheless. Then what they say is, okay, typically 2% of our not due yet bucket will end up being not collectible. 5% of our 1 to 30 day will end up not being collectible. 10% of the 31 to 60, 25% of the 61 to 90, and then over 90 days, they're saying, yeah, 40% of those typically end up not being collectible. So you take each of the totals of each of the buckets times each of the percentages to get the estimated uncollectible for each of the buckets, and you add them all up, and that's how you get this $2,700. Okay? So, same idea here. Determine what the current balance is, what it should be, and then you make the entry, right? So our current balance is $200 in our allowance for doubtful accounts, and it's a credit balance. And it needs to be that $2,270 that we computed on the last slide. So to get from a $200 credit to a $2,270 credit, we need to credit our allowance for doubtful accounts for $2,070, and we need to debit bad debt expense. All right. If let's say that the beginning balance in our allowance for doubtful accounts was a debit of $500. Well, to get from a debit of $500 to a credit balance of $2,270, you have to add. So keep in mind the debit or credit matters when you're talking about what the current balance equals. And the only reason why you would end up with a debit balance in your allowance for doubtful accounts is if you overestimated and then somebody paid you. Okay. All right, so summary of the methods. Bad debt estimation. So you can do income statement focus, which emphasizes matching. You can do the balance sheet focus, which emphasizes net realizable value. Under the income statement focus, there's just one method, percent of sales. So whatever your sales are times your estimated bad debt amount equals your bad debt expense. Under the balance sheet focus, your percent of receivables, you just take your ending accounts receivable balance and say, yep, typically X percent is uncollectible. Then you record your journal entry to your allowance for doubtful accounts, right? Or you can do the aging of receivables and you can multiply each of the buckets by whatever the estimated percentage is, like we just did, and come up with your allowance that way. Now, some companies, now they may take percentages of each of the buckets. I think I mentioned this before. We just take the percentage, 100% of the 120-day bucket. So it's really, it varies company to company, and it's typically based on some kind of historical trends. Okay. All right, so let's go through an example. At December 31st, year end, company estimates its uncollectible accounts using the allowance method. It prepared the following aging of receivables analysis. So in part one, they want to estimate the allowance for doubtful accounts using the aging of receivables method. And then part two, prepare the adjusting entry to record the bad debt expense using the estimate from part A. Assume the unadjusted balance in the allowance for doubtful accounts is a $10 debit. So we care about debit. That is not a normal balance in an allowance account because it is a contra asset. Okay? So, let's do this. So I get my handy dandy calculator out here. Nobody laugh at me. All right, so $2,000 times 0.01. So this guy is $20. $300 times 0.02. This guy is $6. $80 times 0.05. This is $4. $100 times 0.07. Oh, don't tell anybody I used a calculator to do that math. $120 times 10%, or this math. Okay, so all I was doing was multiplying these dollars by these percentages, right? And you add them all up. So I'm going to use a calculator for that too. I'm just going to own it. 20 plus 6 plus 4 plus 7 plus 12, if I did my math right, $49 is what the estimated allowance for doubtful accounts should be using the aging of receivables method. Here's the thing. We want to get to a credit balance of 49, and currently we have a debit balance of 10. So in order to get from a debit balance of 10 to a credit of 49, we need 59 here, right? So I'm not sure what they're doing there. Oh, this isn't going to be helpful because I wrote all over the slide, but here, determine what the balance equals, determine what it should equal, and then make an adjustment, right? Oh, here we go. Look at this. All right, so we have an unadjusted balance of 10, right? We need to get to 49, so here's our 59 answer. Here's all the math across the top that we just did. And then the journal entry we're going to make is a debit to bad debt expense and a credit to the allowance account. Okay? All right, and then part 2. Estimate the balance for the allowance for doubtful accounts, assuming they use 2% of total receivables to estimate the uncollectibles. So if they use 2% and the allowance for doubtful accounts balance is a credit of 4, 2% of $2,600 of receivables is $52. So we had a balance of 4. We need to get to 52, so we're going to credit our allowance for doubtful accounts by $48, and we're going to debit bad debt expense. Okay. All right. Now assume that they use 5 or 0.5% of annual credit sales, and annual credit sales were $10,000. And we have a $2 credit balance to start in our allowance. So we have a 0 bad debt expense currently. Our $10,000 times 0.005 is $50. So our bad debt expense needs to be $50. So to go from 0 to 50 in a expense account, which requires debits to increase the balance, we're going to debit bad debt expense and credit allowance. Okay? All right, so moving on to notes receivables. So a note receivable is a promissory note written as a promise to pay a specified amount of money, usually with interest, either on demand or at a future stated date. So, computing the maturity date of the note. The maturity date is basically just the day the principal and the interest must be repaid. So on July 10th, TechCom received a $1,000 90-day note at 12% as a result of a sale to Julia Brown. So there's 31 days in July minus the days of the note. So it was given on the 10th, which means there's 21 remaining days in July. We're going to add August days of 31, add September days of 30. The number of days we need to get to 90 is 8, right? So 8 days into October would mean the maturity date is October 8th. So our interest computation, this is where I was saying briefly in class that you need to pay attention to the dates. So in order to compute the interest, you need the principal of the note, in this case $1,000. The annual interest rate is 12 times the percent of the year that the note is outstanding. The way you do that, it's a 90-day note. We're going to always use 360 as the number of days. Banker's rule. Every month has 30 days. Okay. So 1,000 times 12% times 90 over 360 is 1,000 times 0.12 times 0.25 or $30. That's for the whole 90 days, right? So When we record our note, when we take out the note, or when the borrower takes out the note from us, we're the lender in this case, it's a receivable, right? We're going to record a note receivable of $1,000, and we're going to record sales of $1,000 because they issued a 90-day note for a purchase of something. Okay. So a seller may accept a note from an account receivable customer to allow an extension for a past due payment. So, like typically when you make a sale, you debit accounts receivable and you credit sales, right? Well, let's say that accounts receivable is now aged quite a number of days because the tenant or the customer is not paying. You can get rid of your accounts receivable and you can record a note instead so that it comes out of your aging and it goes into more of a long-term bucket on your balance sheet. So the way we would do that, let's assume TechCom agreed to accept a $232 payment in cash along with a $600 60-day 15% note to settle her past due account receivable. So we're going to reduce our account receivable to zero because we're doing some other kind of financing, right? So we're going to credit our account receivable for $832 to take it to zero for J Cook customer. And then we're going to issue a $600 note. So that's note receivable, debit of $600. And we're going to record our cash at $232. Okay. All right, so recording the honoring and dishonoring of a note and adjustments for interest. So when we record an honored note, principal and interest of a note are due on its maturity date. So this J Cook, the note receivable we established in the previous slide. Well, now here we are 60 days later and they've paid us, right? So we're going to record the cash that we receive, but the cash we receive is going to be both the principal and the interest. So our note receivable is going to go to zero, so we're going to debit or credit notes receivable for $600. And then we're going to credit interest revenue for the interest we made on the note. So that's going to be $600 times 15% times 60 days divided by a 360-day year. That 15% is an annual rate. You got to convert it to a 60-day rate, right? So we're going to credit our note receivable, credit our interest revenue, so our debit is $615 cash that they're paying us. Okay? Well, what happens if J Cook doesn't pay us? Right? So we're going to charge the account of J Cook for dishonoring a note. So we're going to put an account receivable on the books for $615 because they haven't paid us, but they owe me. We're going to still record our interest revenue and we're going to still relieve our note receivable. We're just going to put it back into AR. Okay? All right, so recording end of period interest adjustments. So on December 16th, TechCom accepts a $3,000 60-day 12% note from a customer and granting an extension on a past due account. So when TechCom's accounting period ends on December 31st, $15 of interest is accrued on the note. So we need to record our interest receivable and our interest revenue. And to do that, we debit interest receivable and we credit interest revenue. And so the way they're computing that $15 is the $3,000 times 12% annual rate. There's 15 days between December 16th and December 31st. So then you multiply by 15 divided by 360. Okay? So when we record the collection on the note at maturity, the days in December were 31, but we took out the note on the 16th. So we have 15 remaining days in December. We have 31 days in January, 14 days in February to get to a total of 60. So when they pay us 60 days later for that note, we're going to record interest revenue for the other 45 days because we already recorded the 15 before the period ended last year. We're going to relieve our interest receivable because we're getting all 60 days worth from the customer. So we get rid of our interest receivable with a credit of $15. We're going to relieve our notes receivable because it's paid. So we're going to credit $3,000 and we're going to get $3,060 in cash. $15 of that pertain to the prior period, which is why we're recording interest receivable. We're reducing that receivable so that we only have the applicable number of days interest in the current year. Okay? All right. Company AA purchased $1,400 of merchandise from ZZ on December 16th. they accept a 1,490-day 12% note for as payment. The accounting period ends on December 31st, and it does not make reversing entries. Prepare the entries for ZZ on December 16th and December 31st. So, when they take out the note, the customer takes out the note, we're going to record a note receivable on our books to AA, $1,400. And we're going to record sales of $1,400. Then, at the end of the year, we're going to record interest receivable of 7 and interest revenue of 7. $1,400 times 12% times 15 divided by 360. Okay, that's to accrue the interest that we haven't yet received, but we've earned, right? So we want to recognize that revenue. Then on the 16th, when they pay us, we're going to reduce our receivable that we had on our books from December 31st because they're paying us. So that's this credit right here. We're going to reduce our receivable of $1,400 because they're paying us. We're going to record the additional revenue that pertains to 1/1 through the end of the note period, 3/16. So that's 75 days of the 90. So 1,400 times 12% times 75 divided by 360. And then we're going to record an account receivable for $1,442. That would be assuming that they dishonor the note. We're putting it back in receivables, right? If instead they honor it, that becomes a debit to cash, but all of these items remain the same. That's the only difference between honor and dishonor. The entry is exactly the same, it's just whether you debit cash or you debit accounts receivable. Okay? Alright, so assume the facts in parts B above, AAA dishonors the note, and then on March 31st they decide to write it off, and they do it using the allowance method. Then we're going to record a allowance for doubtful accounts of $1,442, and we're going to record an account receivable for $1,442, a reduction in accounts receivable. So if they decide to write it off, they're not writing it off to bad debt expense because they use the allowance method. So all they're doing is they're reducing their allowance and they're reducing their account receivable. Okay. All right, so explain how receivables can be converted into cash money before maturity. All right, so companies can convert receivables to cash before they're due if they need cash or they don't want to be involved in the collection activities. So the way that's done is usually by selling them or using them as security for a loan. So a company can sell its receivables to like a finance company or a bank. The buyer, who's referred to as a factor, will charge the seller a factoring fee, and then the buyer takes ownership of the receivables and they receive the cash when they come due. I don't know if I've ever seen a company actually do this, but by incurring the factoring fee, the seller receives the cash earlier and then they can put the risk of bad debts to the factor. So basically, the seller avoids the costs of billing and accounting for the receivables. And then a company can also raise cash by borrowing money and pledging its receivables as security for the loan. So if the borrower defaults on the loan, then the lender has the right to be paid from the cash receipts of the receivable when they're collected. So you can read more about that in the book, but that's the super summary. All right, so computing the accounts receivable turnover and using it to help assess the financial condition of a company. All right, so accounts receivable turnover measures how often on average receivables are collected during the period. And all it is net sales divided by average accounts receivable. Average accounts receivable is beginning plus ending balance divided by 2. Okay. So in this case, we're looking at the Visa and MasterCard companies, and we're looking at the accounts receivable turnovers. So it looks like, let's see here. It basically shows how well management's doing in granting credit to its customers. Is a desire to increase sales, right? So a high turnover suggests that management should be consider using less strict credit terms to increase their sales, and then a low ratio would suggest that management should consider more strict credit terms and more aggressive collection efforts to avoid having its resources tied up in accounts receivable. So here you could assume that Perhaps MasterCard should consider more strict credit terms, whereas Visa maybe should consider less strict, right? Because Visa is significantly higher and MasterCard's pretty low. So that's how that works. All right, so that's the end of chapter 7. I'm hoping you guys are finding this information to be a little bit less cumbersome or maybe a little less mind-blowing than some of the stuff that we started out with in the beginning of the chapters, beginning of the book when it was all brand new. Now we're getting into some more of the details and the nitty-gritty of the various areas and accounts of your financial statement. So hopefully you find it to be a little bit of a relief and a little bit easier, but should you have any questions or you think I'm nuts with that opinion, you just let me know and we will, I'd be happy to help you work through whatever it is that's giving you trouble. So hope you found this helpful. Take care, guys.